Welcome to Hidden Levers War Room for 27th February 2014. My name is Raj. I'm here with my partner Praveen and all our colleagues here at Hidden Levers. Thanks for joining us for the War Room. We'll say welcome today to some folks from Raymond James. They're joining us for the first time. So my hat tip to you. The War Room for Hidden Levers is a bit of macro coaching and where we introduce new scenarios, update old ones, give you guys ideas, give you continuing education credit. It does a lot that the software can't do, where the human touch is involved, and us as economists, not just technology builders, to help you. Today's session is about the Fed. Since January 1st, we've had a lot of interesting developments at the Fed, a lot of new announcements, a whole new person at the top, and a lot more faces to keep track of. And so we'll consider those new developments, including the brand new stress test for 2014, what they have in mind. We'll show you our scenarios, including Fed stress tests and the end of QE updates, and talk about how to use this toolkit in context of what the Fed has been saying to make your clients' lives better and to make your lives easier. So let's get started. First of all, market update. That's how we start everything, letting you speak a different way to things that have been going on that matter, as opposed to the financial news fear-mongering. First big thing, although we've seen the emerging markets currency route from January turn into a Chinese economy being pooped. A couple of these things go against each other. The commodities gains we've had, both in natural gas and oil prices, and even some precious metals, they've been stark. Precious metals probably due to emerging markets money not being comfortable in its own currencies, and the dollar maybe because taper is starting, unsure where the dollar is going. So Europe has been rising and gold has been rising. So those are the two places where money can go, where people felt it was more of a safe harbor from the emerging markets. One of the things that is in contrast to that is copper. Copper is directly tied to the industrial economy, down, and that's because of China. So that's a big story that was happening this month. And also, as of yesterday, we were flat on the year for the S&P. All the markets, and I would say global equities, even achieved that in the past couple days, back to the flat line after the volatility in January. And as of today, we're back around 1850 on the S&P, so record territory. In terms of home prices, we did have Case-Shiller, a much-awaited pronouncement in home prices. And although you see them going up, Praveen will explain that home prices likely will be taking a breather because they are in contrast to mortgage rates. So that's the things to keep in track of. To us, everything else besides this, and of course the Fed drama, is just noise. So these are things that we'd be concentrating on in terms of the macro picture. Praveen?
Great, thanks, Raj. And wanted to move now to our macro snapshot, where we look at a series of charts and give you a little bit of an update from the data perspective on what's going on in the economy. Since we're talking about the Fed and Fed policy today, the first chart that we're looking at there at the top right, I just wanted to revisit the Fed's dual mandate and the fact that unemployment and inflation historically or traditionally, CPI was the favored measure of inflation. The Fed does look more now at the personal consumption expenditures data set, but nonetheless, CPI is what we're showing here, and CPI has been very muted. If we look at this line, it's staying in below 2% steadily, and even as unemployment falls. So when you look at what does the Fed consider in terms of their policy, inflation is, if anything, perhaps slightly too low. Roger's going to go over that in more detail. But unemployment as well. Unemployment is moving certainly in the right direction, and so the Fed's looking pretty good on that point. Getting a little bit of background noise, Jonas, if you could mute yourself, or anybody who is not speaking, please mute. The second slide that Raj alluded to, home prices and mortgage rates, is the one at the right there, top right there. And I think this one's particularly interesting because it's counterintuitive, the idea that home prices would be rising at times of high mortgage rates and falling at times of lower mortgage rates. But in fact, that's actually what we saw. This is a chart of really the last decade, going all the way back to 2004, housing boom and bust. And precisely because the economy was doing so badly, this is when the Fed was cutting rates, of course, in the 08-09 period, and mortgage rates were coming down with them. And then more recently, we see maybe this is the QE-induced slide in rates, but certainly rates have been coming down again after a short spike in late 2010, steadily down to historic lows in 2013. But home prices, instead of perhaps responding to those low rates, continue to stay at lower and lower levels. Suddenly, home prices start to rally over the last year and a half, 2 years, and what are rates doing? Rates are rising as well. Really what this is speaking to is that homes are sort of becoming more like other risk assets. They're acting like stocks, acting like some commodities have behaved, and they are when risk is on, which is certainly where we've been over the last year and a half, 2 years, and actually even longer. That's when home prices have been rallying. Now, I want to point out this divergence here just at the very end of the chart. Mortgage rates and
Muted. Unmuted.
mortgage rates and yields have hit a wall, and so the question becomes, if mortgage rates and interest rates are flattening out for the moment, does that mean that home prices, if they've been correlated of late, are home prices going to flatten out as well? Or are rates going to continue to rise to meet that trend of rising home prices? So we see a little divergence there, and that's interesting to point out. The bottom two charts, I just want to quickly talk about commodities a little bit because we have seen this bounce back. I thought it was interesting to chart agricultural commodities. This is the Dow Jones UBS Ag Index in blue, and then gold in, and actually that's the green line there. What's interesting about this is that I don't think that most of us, even advisors, investors, realize that the correlation has been this high over the past over 2 years between agricultural and commodities and gold. But another aspect of that correlation is that they march downward together until roughly right around the end of the year, and then they started to snap back, and both have been really shooting upward over the last couple of weeks or month.
Yeah, especially gold miners, actually. They've been rebounding more.
Sure.
That's the more volatile part of that trade. Just because it has the word gold in it doesn't mean it's great gold exposure. And so maybe your gold bug clients or prospects are coming back to you about gold now. Just keep in mind that the volatility of the gold miners, although they've done well in the past 2 months, has been the downside is worse for them.
Absolutely, yeah, and we covered that, or not last month, but a couple months ago in our commodities webinar, the differential there between the miners and the physical commodity. In terms of oil and copper, I just want to show a little bit of divergence here. Historically, these two commodities have traded very tightly together. You can see the correlation from the start of the rally after the financial crisis, early 2009. You can see this correlation holding up until basically the beginning of last year where it started to break down. And all of a sudden copper, which is more of a global indicator and really tracks Chinese economic growth and economic growth in other emerging markets, that seems to have flatlined. It fell and then it's flatlined in this neighborhood, actually around $3 a pound, whereas oil prices have stayed strong and have actually rallied as well quite recently. So a little bit of divergence there, and it's an interesting question as to what is that telling us in terms of global economic growth still being weak. So again, who's right? Is it copper or is it oil? Another divergence there. Let's move.
Okay, and one thing you'll notice in our scenarios is that there is one key economic indicator that help us keep track, and so we are very confident that now copper is the right indicator to keep track of what's going on in a China slowdown. That this is evidence of that. We'll explain that as we get into scenarios. Okay, so Fed up Fed. First of all, 2014, we know that the consensus was over. From back in the Alan Greenspan days, you did have one person speaking at the top of the Fed. In the Bernanke era, he lost a little bit of grip on that, where other governors would make statements, and they, I guess they got balls somewhere to do that. And no one ever had that in the Greenspan era. Now that Yellen's in charge, it's sort of at the beginning, it's a play for power probably, but in the end, what she's inherited is a Fed with different voices. And so here's a montage of letting you know who the characters are. So if you're just scrolling through news stories, look for these kind of people, and then you'll know that they're speaking on behalf of the Fed. And so there is no, she hasn't squashed that yet. It is her right to do that, but mostly they're kind of a cacophonous set of voices. You see Lockhart probably the loudest. The second someone said, hey, mid-2015 there's going to be a rate hike, everybody's paid attention. And so, of course, that voice is going to be heard. He's also been there quite a while, Atlanta Fed on Lockhart. In terms of, at the top, of course, low rates policy, she's towing the party line in terms of what Bernanke started, what Obama wanted. And so that, that's why she's there, frankly. And then in terms of the taper, you have the inflation hawks, you do have the people that, like and the Philadelphia Fed, Mr. Charles Plosser, he's even worse on that end, saying it needs to be quicker. Taper process should be quicker. So the gamut of voices are represented now, and it's more out loud than just in minutes from last month or last year. So that's one thing to keep in mind, that the consensus is over in 2014. In terms of what their views, what we have clarity on, one thing that is for sure is that inflation is the thing that they look at. In terms of even the things they mention in their minutes, I think there's been a few surveys on this. Inflation gets mentioned 10 times more than the word unemployment, and that's their dual mandate. But one of those is definitely in the driver's seat. And so first of all, inflation at this point, it's not some grim reaper. It should be higher as our GDP goes higher. And that's just the way it is. As we earn more, things cost more. It's just a normal thing. But right now, actually, we don't have that. Just the latest economic data that came out, there's still softer spending, so that means people are spending less. You can't really have prices going up if people are spending less, and then less production, so softer production. So if people are producing less, also, it's not going to lead to inflation. So in terms of what they've said, of course, remember there's a huge difference between core CPI and normal CPI. CPI is including all the commodities hijinks that we've had in January. So all the nat gas spikes, 5-year highs in nat gas due to cold weather, oil prices kind of rebounding, and different things. So those are not considered in terms of the Fed's focus on inflation. It's that core CPI, the chart to the lower left there, and that is steadily down in a much more clear picture on where inflation prices is headed. In terms of the tech sector doing quite well, we've definitely seen that with some acquisitions lately. Didn't even think it was worth mentioning at this point, but in all of that hubbub in the tech sector, as it's doing well, as it grows bigger and bigger, if that is the case, it's not like they're using more oil. It's not like they're using more energy to make that stuff, or to not only to create it but to use it. And so that tech sector kind of pushing out our GDP has little to no effect on inflation. And so just know that the economy could be doing well without that huge inflationary push.
Right, and you could actually argue that the tech sector piece is disinflationary, deflationary, because generally speaking, technology is one part of society where people always expect prices to fall, not to rise, and so that may actually, as that grows bigger, cause inflation to be more flatlined.
Yeah. A last point here, this is kind of it made me laugh. The Fed is actually worried about employment going too low. Even though it is their mandate to talk about employment, keep their eyes on the job market, they're worried about it, lower unemployment. So because of two good jobs numbers means people get paid more, and then that is an inflationary event. So, in terms of what they're worried about, it isn't unemployment anymore. They could care less. In fact, that's the next slide. In terms of their view on unemployment, we kept hearing for, I think it was, I don't know, I think since the stimulus started, right? Since quantitative easing started, they've been mentioning the 6.5% unemployment threshold, and we will not stop quantitative easing until then. So what I want you guys to do is just get that out of your head. It doesn't matter anymore, that number. They're never going to, just it's at this point it will be that top line number doesn't have the kind of telling nature it did. The economy is not homogeneous. The society is not homogeneous. You have labor markets are much more nuanced now, where educated people kind of have easy job opportunities. The working class is only increasing in services because the middle class is disappearing. So if you, as that middle class disappearance story happens, you have a very fragmented job market, and also the youth. As you have an older population that isn't retiring or dying, right, because of healthcare or because they need that money now, then that keeps the youth, that kind of millennial generation, down in the ranks of the unemployed. And so that number is still rising, and it hit 20% in February. So it's very, with such disparate, nuanced unemployment picture, it's almost irrelevant to look at that top line number. I mean, I'm sure you guys hear it all the time about inequality. So as inequality increases, then why do we bother with this average number? We don't care about GDP in India for that reason, right? We just care about per capita GDP doesn't really matter. It's more about there's really rich people and really poor people. And so as that happens, same with unemployment. In terms of, is unemployment losing its relevancy as kind of as an indicator, just know that that's not only to the Fed. If you look at retail, Praveen is the first to point this out. You've got a Saks Fifth Avenue doing really well. You've got Walmart doing really well, and of course in the middle, the J.C. Penney's of the world haven't been. So that same trend is reflected in unemployment data in general. So yeah, and there's as we can see, there's plenty of other things losing the relevancy in 2014.
Sure.
Praveen, I'll turn it over to you for taper.
Sure, yeah. Well, let's talk now. If we're looking, we looked first at the Fed and the mandate in terms of their views on inflation and unemployment. And now let's talk about their actions, so the Fed's actions around taper and quantitative easing, and then we'll talk next about the Fed's actions around interest rates and what is the view on interest rate hikes. So this first chart, the top left chart here, is actually from Goldman Sachs, and to the right, of course, of 2014, this is their forecast. To the left, this is just sort of a historical graph showing the net amount of quantitative easing in terms of money injected into the economy in different ways through purchases of either mortgage-backed securities, treasuries, different types of debt, and so that's showing how big, of course, it was during the actual financial crisis, and then QE2, QE2.5, or whatever we want to call Operation Twist, QE3, and wherever we've been for the last couple of years. And this is the steady taper. The forecast here is that, at the current trajectory, roughly $10 billion coming off per Fed meeting, taper would finish by the end of Q4, so effectively within 2014. So taper would finish. There'd be no incremental purchases of treasuries or mortgage-backed securities at that point in time. But it's important to note that, as Raj showed, there is disagreement rising at the Fed. And I should note that within that disagreement, we see, Plosser, Raj mentioned, we also see the Dallas Fed Chair Fisher and some of the other folks who tend to historically be more hawkish. But at the same time, who is the new chairperson or chairwoman? Janet Yellen. She's historically known as a dove on the Federal Reserve, and she has the chairman or chairwoman spot. And so despite this, this being the current forecast, even today we heard it in Janet Yellen's testimony that they're going to watch closely the economic data and they're prepared to react in different ways based on that. So that's the taper forecast, and this is a Goldman forecast, but if you just sort of straight line it out, this is roughly what you get is the taper ending by the end of 2014. In terms of what that means for interest rates, this is a simple model here at the right put together, and actually this was in Kiplinger, a simple model looking at past easing and interest rate hike cycles and looking at what would happen to rates, as QE scales down. And so two different lines here. The green line is an assumption of a 0.1% rise after every meeting in which a taper occurs. And so we see, going from January 14 out to December into Jan 15, the 10-year rate rising up close to 3.7, 3.8%. So roughly 100 basis point move over the course of the year as QE is wound down. The second line is a more conservative estimate, and it basically takes you to half of that, so 50 basis points. So these are two different projections of the way that interest rates might change. And so these are outside projections. What's interesting is let's sync that up now with the Fed themselves, and then take a look at their view of interest rates and what's going to happen from that perspective. So that was the previous slide was looking at expectations on the 10-year and how would the 10-year move as tapering continues. So something like 100 basis points was the higher projection that we saw there. In terms of interest rates and looking at what the Fed thinks, actually starting down in the bottom corner, just to continue on that thread, this chart here with the different red and blue lines, this is actually the this is from the San Francisco Federal Reserve, and what they did was they went through and analyzed all of the official statements of the various members of the Open Market Committee, so the Federal Reserve governors, the voting members, and they looked at what are their own projections as to what the rate curve is going to look like. So this is for the Fed funds rate, but the median, actually virtually all the governors are basically saying in 1 year, this is from December last year, so basically December 2014 or end of this year, they expect rates to start rising around that point in time. And you look 6 months out and they see, or 6 more months out, so this would be mid 2015, they see short-term rates closing in on 1% for the most hawkish of the FOMC members, and then really more like 0.5% for the midline. And it goes on out from there to the point where when you get 3 years out, so this would be end of 2016, you've got 2% Fed funds rate, for the median, and then the most hawkish members are pushing up towards their forecast is for something closer to 3%. So in that range. So that's telling you what the Fed themselves are saying. And so that's looking at interest rates from that picture. The upper graph here is looking at interest rates and inflation forecasts from a market perspective. And again, this is aligning. Markets are essentially expecting the Fed funds rate on the right axis here. So this is the Fed funds rate, this orange line, basically sitting next to zero all these years, and really popping up to around 1.5% in 2015. So very much in line with what the Fed is putting out. Maybe that means the Fed is communicating more clearly these days. And then 2016, up to 4%. In addition, the market forecast is seeing a rise in inflation, although it should be noted, as Raj pointed out, we have not seen this in the data. They're looking for a rise, in inflation towards 3%. If anything, we've seen inflation flatlining. So that part hasn't held up thus far.
The funny thing is, this is a self-gratifying chart because they're assuming that that they will, do perfectly on inflation. That means that they will kick it up to between 2.5 and 3, and then it'll just stop. I find that hard to believe, but the chart does assume that they execute perfectly and are able to rein in inflation when it's at the right level.
Right, and certainly, the way, even when you look at the Fed, FOMC members' own forecasts, these are really linear, and so it's just drawing straight lines out and assuming that you can go along that trend without either slowing the economy down too much through rate hikes, or maybe you're going too slow and inflation's starting to pick up too much, and so it's right now a very simplistic forecast, and that may be one reason why the Fed is always dithering around when we're looking at the data.
Actually, now that I think about it, there's two assumptions there, right? In that one is that they can get it that high because until the kind of commodities popping that we've seen in January, February, really we were on a heavy commodities deflation paradigm, right? You did have an equity melt up because of the quantitative easing in effect, but really every commodity was traveling the other way. So yeah, you've had bad weather and other things that have made a short commodities rally happen, but should that, we don't know yet. So really they have to get out of deflation and then rein in inflation at the right time, none of which they've done yet.
Right.
Okay, so that brings us to the recap on the Fed pronouncements. 4 big points to keep in mind. We usually finish the big sections like this. 4 points to keep in mind as a takeaway. 1, unemployment losing relevancy as a top-line number, and you'll notice that there's going to be more volatility in the markets due to that, actually. On those days when unemployment comes out, it's that big announcement's made. It's, probably the market moves two different ways, the same way it does during options expiration week, because people are parsing through and seeing different stories being told by all the unemployment data. So that's that. End of QE, just know that there's going to be probably some kind of gap, maybe even up to half a year, between when taper stops and then there's an actual rate increase happening. So there'll be that window of 6 months. So it's not like whatever decisions you make on fixed income, especially, you have to be exactly right. You'll have a little bit of time. In terms of the commodities rise, as I just said, they have been rising. It's way too early to say if inflation is happening. And then if inflation does happen, that's a good thing. So know that with your clients, we have to remember that inflation is part of the growth story, just not too much. Just like dessert, it's good, but not too much. Okay.
Right, and we actually have a question, Raj, now that I'll pick up. And so the question is, can you incorporate these projections into your modeling? In essence, can you make a scenario for this? And so we're going to be actually looking in a moment at the scenarios. That's actually the next section, and so that question turns out to be a convenient segue. But looking at different Fed scenarios, and we have actually incorporated the Fed's own projections. We'll look first at a set of scenarios that are explicitly from the Fed and based on the Fed's official stress testing forecasts. And then we'll look at our own end of QE scenarios and review those as well.
Yeah. Thanks. We could have almost paid you to ask that question right at that moment. Perfect segue to scenarios.
Right, exactly. And so let's talk first about let's talk about the set of scenarios that are from the Federal Reserve first. What these are, and we've had these in HiddenLevers actually for over a year, and we recently updated them. Every year since the financial crisis, certainly starting I think they were starting in 2011, and they had a 2012 and 2013 release each. They release in November each year for the following year. And what these are, that's the first quote up top. Dodd-Frank stress tests are regulatory tools the Federal Reserve uses to ensure that financial institutions have adequate capital. And so these are the bank stress tests, the stress tests that were originally used going back to the financial crisis or the aftermath of the financial crisis. And they were put into law to make sure that banks are adequately capitalized in the case of a range of downside scenarios. So the official stress tests that are released by the Fed, and those are actually linked to on the slides, which you guys will have access to down here in the source link. But 3 scenarios are released every November, and so last November was the latest set. There's a baseline, there's an adverse, and there's a severely adverse. Essentially a good or good to neutral, a bad, and an ugly, with different nuances, but that's essentially what it comes down to. And the Fed actually, what's nice about it from our perspective is the Fed releases not sort of some generic proclamations that you'll sometimes see from various economic analysis firms. Instead, they actually release what they think something like 40 different economic indicators are going to do. So we're able to take their scenario and literally plug it straight into HiddenLevers and build it into a scenario just by looking at what their forecasts are. Now I mentioned that
actually, it's a good point, Praveen. I mean, if you think that reams and reams of prose is economic research, the Fed and HiddenLevers are the ones that don't think so. They're just a set of economic assumptions.
Right, yeah, it's actually very, very convenient. You guys can download them yourselves and look at what the Fed's economic assumptions are. It's a simple spreadsheet with all of the projections in it. Now, what are the differences between last year's and that, meaning the ones released in November 2012 versus what we updated in November, December 2013, the 2014 stress tests? Well, the major differences are that equity valuations over the course of 2013, as everybody knows, they ran up much higher, with the S&P up over 30%, and most major markets up in that neighborhood. So equity downside risk is perceived as being much greater in the adverse and severely adverse scenarios that the Fed just put out. And that's that notion of the second one: the risk on equals loftier valuations, and therefore you have further to fall. The other aspect, though, is that the yield forecasts. So the stress test models assumptions around what's going to happen to interest rates in these different scenarios, those forecasts were raised as well. And so we'll look at that. If I jump through, we're going to look at two of the scenarios in more detail, the baseline scenario and the adverse scenario. The severely adverse scenario, I'll just mention in passing, is more similar to the financial crisis. That's essentially a financial crisis repeat. We definitely have it built out on Hidden Levers, but we're not going to cover this closely right now. We wanted to focus instead on the baseline scenario and the adverse scenario. The baseline being, everything continues all good and well, and the Fed actually had a projection of the S&P being up another 10% from current levels. I say current levels, meaning in the 1840, 1845 range, which we're even up from that again today, because when they made the forecast, it was actually plus 12 or plus 13%, and the market has moved. And this is an illustration, actually, of how Hidden Levers tracks scenario progress. So as the market continues to rise, we're tracking that and adjusting the scenario for that. But so from here, from where the S&P stands today, looking at a plus 10% through the end of the year.
You'll recall that scenario progress that happens, if their scenarios are up, people ask us all the time, how often do you update the scenarios? Well, the machine is updating them every day in terms of pricing them in more or less. And then the economic research team here is also updating them based on news that's released or events that happen.
Right. One more question that I'll mention, and actually I think, Raj, you can cover it a little more when you get into the end of QE scenarios, is the fact that Japan cut its rate to 0.5% in 95, and it hasn't changed in almost 20 years. And the UK is in roughly the same boat. Why would it be any different in the U.S. without runaway inflation? So we actually don't disagree, I think, with that, with that statement. And when we look at the end of QE scenarios, Raj will show, our upside from a market perspective scenario really doesn't have necessarily a whole lot of inflation and runaway inflation built into it, because that's what the market's been showing us of late. CPI has not been a problem over the last several years, even during this record run-up. So continuing with what the baseline scenario looks like and differences to note, a key point I want to make here is that from the 2013 version of the scenario to the 2014 version, the Fed raised its model expectations of 2016 interest rates. So last year's forecast had 4% as got a little New York background noise for you there. The 2016 forecast was for 4% interest rates last year, and then when they went to update it more recently, it moved from 4 to 4.4%. So that just illustrates how the Fed themselves are shifting their assumptions towards higher interest rates. This is the 10-year, of course, that we're talking about. So a 10-year going up to 4.4 by the end of 2016. The other key point to note is that the Fed is also not overly optimistic in terms of actual unemployment. GDP growth. Plus forecasting a very, very modest improvement. Basically, we're going to stay in this mid to upper 2% range. The days of 3 plus, or maybe even 4% plus economic growth like we had in parts of the 80s and 90s, that does not seem like it's close at hand, and certainly it's not in these forecasts. Not even in the upside forecast. Now let's look at the adverse scenario. So this is the Fed's bad scenario, not the ugly financial crisis repeat scenario, but the middle bad scenario. And a key difference here is that last year, again, when the Fed created their stress test for 2013, they had a roughly 25% drop built into equity markets, so the S&P 500 and U.S. equities, if the adverse scenario played out. This year they raised that to a 34% drop, and a big part of that is the loftier valuations, and noting that if we do have a correction from here, that needs to be taken into account. So that's one aspect of this adverse scenario that's changed. Another aspect that is changed and is a bit different from what one might expect is in this adverse scenario, the Fed is actually planning for stagflation. So they're looking at a scenario where, look at what the 10-year does in this scenario. It's going from current levels to more than double. So the Fed is looking at a scenario in which interest rates rise rapidly, perhaps get out of the Fed's control. That's essentially what this scenario is painting a picture of, where there's a recession, GDP growth goes down to 2%, negative 2%. Well, you would say, based on the Fed's behavior over the last decade or more, that if GDP growth went down to negative 2%, the Fed would intervene with various programs to try to lower interest rates, to try to start growth up again. And instead, the Fed is modeling out a scenario here where, well, what if we can't do that? What if, for some reason, yields get out of our control and skyrocket up almost 300 basis points? So,
well, they're assuming that they are able to stoke the inflation fire.
Right. Well, this scenario also has rising inflation. I mean, not to the point of runaway inflation, but it definitely has real rising inflation. Sharply rising unemployment as part of a recession. But I just want to know that this is very different. I mean, and honestly, this is different than the way that we have it modeled out in our end of QE.
It's a watershed moment for the Fed because, under the Yellen Fed, they think that, apologize about the fire trucks, they think that they're going to get inflation, that there will not be a Japan-type deflationary thing. So, the Bernanke nightmare was deflation. He was really worried about it, and so it seems like under the new regime that isn't a worry as much anymore, not nearly as much.
Right,
They're
absolutely.
much more worried about taming inflation. So again, that two-step process, the Fed being able to stoke inflation and then containing it when the time is right. And so, but they're not mentioning as much as we would like them to about the downside risks dealing with a CPI going down, that balloon lever, the third one down.
Right, the risk of the deflationary or disinflationary spiral. Well, so that's the Fed's, the baseline and adverse scenario and what they're looking at. Let's look now at...
Did you talk about the S&P larger drop?
I did, yeah. We did mention that. And so let's talk now about our end of QE scenarios and what's changed, what's new there, Raj.
Okay, in terms of our end of QE scenarios, now we're in a position where there were some outliers that we had covered last year, namely a bond exodus. We modeled that off the 1994 bond crash that happened, where you had a largely flat kind of S&P not reacting, and then a bond people exiting bonds and rates staying high. So in any case now. We can get rid of the bond exodus mostly because it's priced in. 2013 was not the best year for bonds, and the image there in the back, the two gentlemen. I mean, no matter what you hear about them in the news, let's face it. That's all drama, and we're all about getting to the heart of any matter, not relying on kind of the financial news networks and their need for theater, but really it's just that bonds sucked in 2013, and so the biggest bond fund in the world, they're going to have fights. That's basically it. If they had a banner year for bonds, that I guarantee you that L. Ariane would still be there, and that's it. So in terms of what the difference is now, why we're getting rid of some of these, of course stagflation isn't happening. We've got a lower inflation that we need, and CPI, the core CPI is heading lower and lower. And if unemployment numbers are going down with it, then stagflation's off the table. It means the exact opposite. So that scenario that exists on Hidden Levers, but no longer is it something you talk about in the conversation on taper or quantitative easing. According to us, according to the Fed, may be, and that's where it lives in Fed stress tests. In terms of our own modeling, in terms of that, I would say we were wrong on our bond exodus scenario because we had an S&P staying flat just like 1994, and of course we've been wrong. You've had a bond exodus. Meanwhile, all that money is coming into equities, and so while that's been happening, that bond exodus scenario on our side was it could have been better. But now that it's priced in, we don't, and the reason we're saying it's priced in, you can see the 3-month chart there on 10-year yields. Since the beginning of the year, 10-year yields have been coming down, and then a couple bond, I think ETFs there, the long treasuries, TLT, and the AGG, the big, kind of bond proxy, those have been headed up since the beginning of the year. And you'll probably notice the bond parts of your portfolios doing not so bad. Of course, not as much as the NASDAQ, but definitely not so bad. And so we feel that that bond exodus is priced in because 10-year yields have started to come in, even as the equities are rising. So we're saying goodbye to those outlier scenarios, and we're sticking to the core now, the kind of good, bad, ugly paradigm. In terms of the ugly, we do feel that it's not going to be a stagflation idea like the Fed. It's much more about deflation, the same thing we've been talking about, the same thing that's been happening in Japan for 20 years, that kind of thing, where GDP growth is down, inflation stays down, and the S&P comes down with it, and rates have to stay low. In terms of an economy back on track, we are back on track. That scenario is completely priced in on HiddenLevers now, and the original projections for that were 10-year at just over 3 handle, and the S&P at 1900. Well, today we definitely tagged that 3%. It's come down since then on 10-year, but the S&P we're almost at 1900. So whatever projection there was, S&P, an economy back on track. The train is definitely back on the track. In terms of where we go from here now, the kind of QE infinity idea, that has to die because it's not quantitative easing that's continuing, right? We have a taper in place, so that name is inappropriate now. So in terms of Praveen will always talk about the quantitative easing punch bowl and how it's just replaced by another punch bowl, and so what we're calling that is just easy money, common name for it, but without a hangover. And the hangover means that there's no inflation to deal with. And so we are monitoring that. We have had this commodities rise, and so if there's a need to introduce a fourth scenario on easy money with that hangover, meaning kind of an overdose, right? The opposite of this. So just that nuance where the easy money is coming in, S&P is going up, but high inflation. We'll introduce it. But for this moment, we think it's imprudent to introduce a heavy inflation scenario just yet. And that's because they haven't yet reached, they haven't convincingly gotten over that first hurdle of combating deflation.
Right, and particularly within the context of QE. So just to be clear, whether it's the 1994 bond exodus, and rising interest rates, or stagflation, those sorts of scenarios, all of those still exist on HiddenLevers, and we can show where those where you can find them today. But we're tightening here our analysis of how QE is going to kind of come to a conclusion, if and when it does. Just to add to what Raj was saying about easy money. So when Janet Yellen testified in January, and certainly she reinforced that today, and actually also in early Feb. What was being said there is that, okay, the taper is continuing on schedule, but we're not going to look at unemployment really as to when we raise rates, and so rates are not going to rise effectively until we're ready, until we see the signs in the economy. So although on the one hand we showed you guys earlier that the FOMC is looking at roughly 1 year out to the first rate rise, they in repeated testimony have said, or Janet Yellen has said, depending on what the data says. And so they reserve the right to keep that punch bowl out there and to keep rates at zero. And we almost forget now, because it's been so long that we've had QE around and 0% interest rates, we're almost looking at just the QE part as being, what's called easy money. Well, when in fact it used to be not that long ago that rates were at 4 and 5%, on the short end of the curve. And so, to the extent that we stay at 0 or 25 basis points on the short end of the curve, that to us is continuing easy money and potentially continues to drive this kind of rally in the best case, or if it fails, that's the bad scenario that Raj had pointed out as well.
Yeah, and as we had pointed out, that lag time is so important. Even at the end of the year, as taper ends, there'll still be probably a 6-month period where there is no effect on interest rates from the Fed. So that's still easy money then.
All right, let's move now to talk a little bit about winners and losers. Firstly, just the question, the conundrum that we'll pose, and really this is a question we're going to come back to in a follow-up War Room next month. But the conundrum today, that many investors and advisors certainly feel is this question of, am I too late to the equities rally if you haven't been participating in it, or your clients haven't been participating in it to date? But on the other hand, on the fixed income side, are bonds a safe harbor, or are they a trap now? If we really are getting into a true rising rates environment. So this is the conundrum that you see the double-handled broom there. That is really what it is. It's which way do you go? Is there an easy way out? Of course, we had a sure answer for everything. We would just focus on that, right? But in terms of winners and losers for coming rate hikes in a rising rate environment, we just wanted to point out here, by way of this hidden levers chart, we charted over the time frame in which that 2013 bond exodus was really occurring. This is from early May until the beginning of September 2013. This blue line is 10-year yields, and it actually rises from somewhere in the high, almost to like 1.9%, up here to around 2.6, 2.7. So you get this relatively rapid, close to 100 basis point rise between May and September over the summer, and this is what the bond funds do. You have some of the longer duration funds down as much as 15% over that time frame, and this is on a total return basis. And even some of the less impacted funds still down 5%. So pretty big impacts, and that's really showing that sensitivity of bond funds in particular to interest rates. In addition, I didn't chart them on this particular chart, but if you had looked at mortgage REITs, if you had looked at the BDCs or business development companies, so that's on the equity side, utilities, there are lots of other interest rate sensitive investments that aren't traditional bonds that took quite a hammering over that same time period. The mortgage REITs in particular, did as bad or worse in many cases than some of these long-term bond funds. So those were the losers. Now, in terms of winners, and we had a question in terms of seeing how to get this chart, and so actually we will address that in a moment. Great question. We're about to jump into Hidden Levers actually to show you, in terms of winners, the idea of, I'll put out one idea as a potential winner, and this is something that advisors have actually asked us for a feature in Hidden Levers around this, but it's the notion that if you're invested in individual bonds or if you're laddering bonds on behalf of your clients, now certainly there are risks to doing that in terms of having enough diversification that you don't have too much credit risk, but assuming that you can achieve that piece, you have control over your interest rate risk then. The feature that we've added to Hidden Levers that with this month is a feature called Hold to Maturity. So you can actually check a box when you're adding individual CUSIPs to Hidden Levers so that that bond will be modeled as though you're going to hold it to maturity, and therefore even if rates spike sharply, you're not going to take a loss. The model is not going to show a loss on that basis. It's only going to show a loss if some of the fundamentals get undermined and there's credit risk in the bond. So we wanted to show that. In terms of a further discussion of winners, in this type of environment, next month's webinar, we're going to talk about income and really focus in on that. But let me move
okay,
now.
Praveen, that's a good segue into what to show that stuff in the product.
Absolutely.
So let's
do that.
Start there.
Yeah, let's do that. Let's first quickly look at the hold to maturity feature that I mentioned. I put together a simple portfolio here, just 3 positions, SPY just as an example, and then 1 individual bond that I entered in, and a sample, and then TLT, which is a long-term treasury bond ETF. If I hit edit on the portfolio from here in scenario modeling, of course, you can access it as well. But if I hit edit on the portfolio, you'll see that the symbols that I have in here, and where do you get to? For those of you who haven't seen it, how do you enter an individual CUSIP or a bond position? You hit advanced, and then you hit enter fixed income, and you can key it in. Now, in many cases, if we have the CUSIP in the system, you won't need to enter all the details. But if we don't, which also does happen, then you can do it this way. Once you've got a CUSIP in there, and I can hit edit on the existing one to show you what I did here. So with this sample school, municipal bond issue here, all I did was I checked this hold to maturity flag, and when I check that, then it's telling the system that for this particular bond, I'm going to hold that to maturity, and so therefore disregard any interest rate risk for that bond position. And so that's what I had done in here, and we can actually look if I let me reset the levers to get us back down to 0. So we haven't run a scenario. Everything is at 0. And now as I raise yields, let's raise yields a little bit here, up to, let's say, some of the numbers that we talked about in the presentation today. So close to 4%, so up about 100 basis points. And what we see is, with the second order effects, we see that there's been a positive correlation historically over the last several years between rates and the S&P 500. So the model is showing the S&P rising as well, which of course is driving up the SPY portion of the portfolio. We see TLT, that's the long-term bond fund, is getting crushed. 100 basis point move and it's getting crushed 18%, which is not dissimilar to that performance that it had last summer. The one difference would be, of course, I should take into account time frames so I can put in some income into the equation. So I put in a 6-month time frame for this to occur. We see some dividends now included in the performance, so that raises the S&P a little bit, gives us a little bit of positive performance on this schools bond, and then you still see the massive negative performance on the ETF there. So this is a way really of, for those of you, who do use individual bonds, who do have a strategy where you ladder bonds or you hold them to maturity by design, you can illustrate for clients what the positive impact of that kind of strategy would be.
And a lot of this is, what Hidden Levers does for the more savvy advisor. If they've got hedging strategies, if they're doing things with fixed income, it's more about showing, not just telling. That communication device that lets them know you're not just in the dungeon. You're actually able to connect for them whatever's either active management or models you have in place.
Right, and I wanted to briefly, we had another question to ask, how do we generate the chart showing the 10-year versus a range of different securities? So I was going to just quickly show that example. I came into charting under data center charting, and then I selected charting from the first option. In the second, on the data set, I selected levers, and then I picked 10-year yield. Then under second data set, here I'll just enter some symbols. And if you don't know what symbol you want, you can do a symbol lookup by clicking on that. But I'll enter multiple symbols with spaces here. So let's see, we'll do TLT and BLV we had, and I think PIMCO total return. That's 3, for example. And then I can hit show chart or widget, and it will chart that for me. By default, it's showing it on 2 different scales, so I can change that a couple of different ways, but I'll show you how to do it right on the chart. I can hit options, and we've modified these menus to make them a little bit easier to use, where the custom dates are right in here as well. I can hit display all data on 1 scale and apply that, and actually now it's showing me on 1% scale. It's showing me over the last year how rates have gone from 1.9 up to 2.7, and it's showing that minus 6.5% return on TLT, minus 3 on BLV, and actually roughly flat for PIMCO. And in order to the last step that I made whenever I generated that chart we saw before was I actually changed the dates. So I was looking at May to September of 2013. And if I just do that, then it shows me, that's pretty much the chart with just a few less symbols that we looked at in the presentation.
Okay.
One other feature, since we were going to talk about it in a moment, Raj, I'll just share that since we're looking at charts now, and in terms of new features, we have added a much easier share option to our charting package, and so you just mouse over share, and you can see Twitter, LinkedIn, Facebook, email, and then a link. And so we've made it a lot easier for you to share content out to clients or to put it out in the media.
Okay, well, let's take a look now in the site, a couple things before we get to the product update about where you can find some of these things in Hidden Levers and use the toolkit in context of the Fed's pronouncements. So first of all, we'll go to scenarios. Praveen, if you could show that.
Sure. So we've got a couple of different scenarios that we wanted to show in terms of end of QE, Fed stress test, rising rates, and we'll look at that. We've already looked a little bit at how to enter fixed income, so we'll move past that one. But if I go under scenarios to scenario library, then end of QE is right here under trending, and you'll see, those of you who have seen it, have been in here recently, you'll see that we've moved now to having, we had 5 outcomes here previously, but we've reorganized it now so that we've just got the deflation strikes back, the easy money, no hangover, and the economy back on track. Those 3 scenarios are still in play there.
Okay.
And then looking for the next one,
Go
rising
to
rates.
domestic.
Sure. Yes, for the Fed stress test. So under domestic, we have the Fed stress test 2014. And if we look in here, here's the baseline scenario that we mentioned. That's the positive scenario on the from the Fed. Their adverse scenario.
And
then
if you
there's
want a
severely
link, you can
adverse
go to the
scenario.
scenario notes. Just below that kind of scenario progress area, you can see where to get that's the 2012 ones, or 2013.
Actually, they've kept them all in the same place, and so
Okay.
you can link right to the Federal Reserve's page, which is about stress testing. It's not the easiest to read in the world, but if you go through these, you can find all the Excel spreadsheets and all of those things if you want to see the assumptions that they used. But we make it easier for you.
If you're not interested in any of that stuff, then you can see the article that's right above it, summarizing some of those results.
Sure.
Right. There you
Absolutely. Go. And so just to show you now where some of those scenarios, we mentioned how we were moving some scenarios out of end of QE. Well, here under monetary, we have inflation and rising interest rates. So for those of you concerned with a stagflation scenario or stagflation environment, we absolutely have always covered stagflation as a scenario since HiddenLevers' inception.
Right, as a hypothetical.
Yeah, and so that forward-looking stagflation scenario still exists, and you can look at that.
Right.
The other one to mention there would be the rising interest rates. And within rising interest rates, this is where we'll find the 94 bond crash. So if you are interested in modeling a sharp bond crash, even more severe than what happened in 2013, where rates go up really fast in a short period of time, you can find that here.
Right. And then the other ones, I mean, this is one of the most nuanced conversation, especially between you guys and your colleagues and your prospects and clients is that rising interest rates story going to be driven by growth or by inflation? And so just that nuance will make you look much smarter than the clients that you deal with. And it is the truth. That nuance tells the story about what the Fed has to do too.
Absolutely.
Okay, let's go back to where else to look. I think that's good. Oh, we do have macro themes for those of you on the Pro license or Elite. You're able to have these portfolio management tools, one of which is the macro theme library. So just the same way we give you canned scenarios on the stress testing, these are upside scenarios, opportunities as opposed to risks. And so who are going to be the winners in rising rates? And so we give you a few right there, but if we go into this kind of search mechanism, you'll see all we did was set up a screen by 10-year treasuries and show me all the securities that are highly correlated to 10-year treasuries, so they'll go up when 10-year treasuries go up. And so here you can see in that blue text, that's the industry grouping, and if it isn't screaming out to you, I'll tell you it's insurance companies. So that's casualty, life insurance companies. Those have been doing quite well as rates have been rising for the past 6 months, and should continue to do well as we move into rate hike mode and kind of get rid of this new normal that we've been having.
And some of the floating rate funds as well is some of what we see here.
If you notice, they're ranked by their beta to 10-year treasuries, right there, that 10-year U.S. Treasury impact.
Absolutely, and you can pop out the chart and see, how. So this is an insurer called Gainsco that actually you can see how over time how it's fluctuated with 10-year rates, right in the chart.
Okay, definitely a good way for you guys to start your research if you are looking for a new fund manager to take advantage of that higher rates mode. I guess that's about it for the for where to find it in HiddenLevers. Let's move over to a product update. You noticed the charting redesign. If there was one thing that Praveen left out of that, it was that the logo now that you replace in the charting, it can be hyperlinked right to your site. So Praveen, if you go to that for a second.
Sure. So if I go back to a chart, or actually the easiest way to do it would be, well, let me do it this way. If I go into charts, I'll just quickly generate.
You can go to recent charts.
I'll just generate a quick one there. That's right. And so you'll see now we've got a logo in the corner here, which we can link to your site.
Anywhere.
and under, well, yeah, actually anywhere, but under your account settings now, for those of you who have the branding features enabled, you can load your logo, but the new feature is that you can enter your website URL. And if you enter your website URL and choose to enable logo on charts and widgets, then what will happen is whenever you generate a chart, you'll have your logo, and that will be a link out to your website or to any location you choose.
Yeah. And why is that great? When when you're sending in an email blast to a lot of recipients, I would include a chart in there. Why? Because they're bored by more than 2 paragraphs. That's just how we are nowadays. And so this gives them a quick action link to go back to your website. Bring them back into your realm, wherever you're going to do your lead gen. If you have a Twitter feed, if you have any sort of social media presence on LinkedIn, anything like that, whatever charts you drop, now you have a way back for them to attach that back to your website.
Mm-hmm.
If you're a customer for our lead gen application, then that can bring them right back into that if you wish.
Right.
So
on another note, and this is sort of related to the commodities. In the update at the top of the presentation, we did talk briefly about commodities and about how many of them have been surging of late. Well, how would you know that? How would you find that? In fact, how did we find that? The answer is a feature that we've added to the Economic Data Center. So if you go to Data Center Economic Data, or actually it's available right when you log in as well, you'll see a section in the bottom left corner showing the most active levers. And it's showing us that agricultural commodities, NASDAQ, which is of course breaking out, and a couple of emerging markets currencies. It's summarizing those on this active tab of the data center, where you can see a handful. By default, it just shows the top 5. These are the fastest moving economic indicators that have the highest 1-month trends relative to how they typically move. So these are kind of moving up the most rapidly. And you can flip this over and you can actually see the biggest losers as well, if you want to look at it from that perspective. So we see that the VIX is coming down and corporate bond spreads are coming down and so on. So valuable for those of you PMs out there who really want to follow certain trends, and this certainly helped alert us to the fact that agricultural commodities and some of the other commodities were rising as fast as they are before it became clear more broadly to the broader public.
right, and that's our mission of democratizing economic data now is coupled with serving it up on a silver platter. And so especially as we get into the risk monitoring kind of build out, we're very much about that, bringing it to you as opposed to you going to look for it. So that we're getting there.
Right.
In terms of we covered fixed income and the option to hold the bond till maturity. In terms of securities risk profile, now we do have manager tenure and some other fun characteristics around there, so look for that in each security as you do your research. We also have a new integration partner, a CRM system called Grendel. Take a look at it. It's one of the best we've seen out there, a lot cheaper than Salesforce, a lot more customer service, and small outfit that's doing stuff in the cloud and innovating. In terms of the big picture, we do have some things coming down the pipe in terms of risk monitoring. Praveen, do you want to talk about that?
Sure, yeah. We've been talking about this a little bit, so apologies if it sounds like, we keep on hyping it up and never have anything to show. But we do have our risk monitoring first release scheduled to come out shortly, hopefully this weekend. And so what you'll see there, this is the idea that we're going to automatically run a set of scenarios that you can customize. We're going to run it against every portfolio that you have loaded into HiddenLevers. And so if you've added your sync to your custodian or to other software, it could be against your entire book of business. We'll stress test all the portfolios, and once that's done, we will send you an email summary and alert you to which portfolios are the most at risk based on scenarios you selected. And you'll have a dashboard that enables you to look through the portfolios and see at a glance which portfolios and which accounts you should be worried about when it comes to when it comes to that. And we have a related question, being asked about what is the loss tolerance on the edit portfolio screen. What does that mean? That's actually tying into the risk monitoring release that we're going to be doing. So right now, that as of today, that loss tolerance is just a number you can key in. But starting with this risk monitoring release, we're actually going to measure when we're stress testing all of your portfolios. We're going to measure for each scenario whether or not that portfolio exceeds the loss tolerance. So for
Why
instance,
don't you show the functionality?
sure. So let me go and show. See if I can get back in here, and I'll look at a particular. I'll just pick a portfolio, and what's being referred to is this loss tolerance number here that you can edit, and it's defaulted to 20% right now. So what that means is that when the risk monitor runs across all your portfolios and it does those stress tests, it's going to flag the portfolio if the loss exceeds 20% in any of the scenarios. Now you can modify that, so maybe if it's an aggressive portfolio, you might want to raise the loss tolerance, to 30 or beyond, to whatever you think is right. If it's a conservative portfolio, maybe it's the opposite, or a conservative client. But so you can control that loss tolerance, and that's the threshold that's going to determine whether or not you are alerted in the scenario in the risk monitoring when the scenarios are executed.
And there's plenty of other software programs or your own practice where that loss tolerance number could come from. Whatever conversation you're having with a prospect or new client on the risk tolerance, that goes in there. That could have come from MoneyGuide Pro. That could have come from eMoney Advisor, from Finametrica, from Riskalyze. There's several. It's a question that you should be asking at some level of your client or prospect, and enter it there. It's more from a financial planning part of your practice. That could happen. Okay, so that brings us to the end. Thank you guys for joining us. Next month we will have a risk monitoring alpha to talk about for you guys to hack away at, and plenty more to talk about. As Praveen said, we'll be discussing income and how to get it, just the bread and butter of what we do. Okay, guys, well, for Praveen, myself, and the rest of the team at HiddenLevers, thank you so much for joining us and being loyal customers. I do want to say thank you again for all the Raymond James folks here, and we'll see you next month.
Great. Thanks, everyone.